The Great Sun Belt migration of 2020-2022 is experiencing a dramatic reversal that no one saw coming, and it's reshaping America's real estate landscape in ways that experts never predicted. Nearly 40% of families who packed up and moved to Florida and Texas during the pandemic are now planning their escape back to New York, Ohio, Illinois, and California, specifically the Bay Area. Thousands of frustrated homeowners are already selling their homes and heading back to their roots, a trend that's sending shockwaves through the real estate market. Today, we're diving into what might be the most significant real estate story of 2024. And trust me, this isn't your typical market update. We're going to uncover why thousands of people who fled to the Sun Belt during the pandemic are now making the surprising decision to return back. This isn't just speculation. We've spent months analyzing data, interviewing real estate experts, and talking to families who've lived this reality. Let's start by understanding just how massive the initial southern migration was. During the pandemic years, Florida and Texas seemed unstoppable. Florida gained over 444,000 residents in 2021 alone. That's like adding a new city the size of Miami. Texas welcomed 380,000 new residents, many fleeing from higher-cost coastal markets. People were drawn by promises of lower taxes, affordable housing, and a lifestyle that seemed too good to pass up. But here's where the story takes an unexpected turn. By late 2023, both states started experiencing their first net population losses in decades. Redfin's latest data shows searches for homes in northern states by current Florida and Texas residents have skyrocketed by 71% compared to 2022. But that's just the beginning of this remarkable shift. The dream of southern living has collided with a perfect storm of challenges that few saw coming. Let's break down the harsh realities that are driving this reverse exodus. First, there's the insurance crisis, which has become a nightmare for homeowners. In Florida, property insurance premiums have exploded by an average of 300% since 2020. Let me put that in perspective. A homeowner who was paying $2,000 annually for insurance in 2020 is now facing bills of $6,000 or more. Citizens Property Insurance, Florida's insurer of last resort, has seen its policy count soar from 700,000 to over 1.2 million in just 2 years as private insurers flee the market. Texas homeowners aren't faring much better. Besides the 28% year-over-year increase in property insurance premiums, they're grappling with additional challenges. The Texas Department of Insurance reports that some areas have seen premium increases of up to 45% due to severe weather events and infrastructure concerns. Climate concerns have become impossible to ignore. Florida experienced 25 days of heat index values above 110 degrees Fahrenheit in 2023, shattering previous records. Hurricane frequency has increased by 40% in the past decade, with the National Weather Service predicting this trend will continue. The Union of Concerned Scientists projects that by 2030, nearly 64,000 Florida homes will face chronic flooding. In Texas, the power grid issues have become more than just an inconvenience. The Electric Reliability Council of Texas issued 22 conservation alerts in 2023 alone, triple the number from previous years. The state's isolated power grid continues to struggle with extreme weather events, leading to unpredictable outages and soaring electricity costs. Now let's explore why former Exodus states are becoming the new hot markets, with some surprising data that's turning conventional wisdom on its head. New York's comeback story is particularly compelling. Manhattan's median home prices have dropped 5.5% in 2023, but that's just part of the story. The city has seen a 24% increase in new business formations compared to 2019, with the tech sector leading the charge. Google's $2.1 billion purchase of their Manhattan office building and subsequent hiring spree has helped fuel tech job growth of 18% since 2022. Brooklyn's transformation is equally remarkable. With inventory levels down 22% year over year, we're seeing the return of bidding wars, particularly in neighborhoods like Park Slope and Williamsburg. The borough's median rent has stabilized at 15% below peak pandemic levels, making it increasingly attractive to young professionals and families. The Bay Area's revival defies the tech doom and gloom headlines. Yes, San Francisco's median home prices are down 12% from their peak, But this correction has created a rare entry point for buyers who were previously priced out. The city's office vacancy rate, while still high at 24%, has started to decline for the first time in 3 years. Major tech companies have quietly resumed hiring, with job postings up 28% in Q4 2023 compared to Q3. Venture capital investment in Silicon Valley has shown remarkable resilience, with Q4 2023 seeing $12.8 billion in new investments, approaching pre-pandemic levels. The region's innovative spirit remains unchanged, with patent filings up 8% year over year. The data supporting this reverse migration is overwhelming, and it goes far beyond just moving company statistics. Let's dive into the numbers that tell the real story. Moving company data paints a clear picture. United Van Lines reports a 42% increase in moves from Florida to northern states, while Atlas Van Lines shows a similar 38% increase from Texas. But it's not just about the volume of moves, it's about who's moving. Their demographic data shows that 61% of these movers are professionals, aged 35 to 54, often with school-age children, representing a significant shift in family migration patterns. Let's dive deeper into the market indicators that are reshaping the real estate landscape across the regions. The data tells a fascinating story about why this reverse migration isn't just a temporary trend. In Florida, we're seeing concerning patterns in the commercial real estate sector. Office vacancy rates in Miami have climbed to 16.8%. while Orlando is experiencing a staggering 18.2% vacancy rate. This has led to a 15% decrease in commercial property values since 2022, affecting overall market stability. The retail sector isn't faring much better, with strip mall occupancy rates dropping by 12% in the past year. Texas markets are showing similar stress signals. Dallas-Fort Worth's new home construction permits have declined by 32% year over year, while Houston's pending home sales have dropped 24% in the same period. The median days on market for existing homes has increased from 22 days in 2022 to 45 days in 2024, indicating a significant slowdown in market velocity. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Let's contrast this with northern markets, where we're seeing remarkably different indicators. New York metro area. The Manhattan luxury market has seen a surprising resurgence, with properties above $4 million seeing a 28% increase in transactions compared to 2023. The borough's new development pipeline has shrunk by 35%, setting the stage for potential inventory shortages by 2025. Brooklyn's townhouse market has exploded, with median prices up 18% in prime neighborhoods. What's particularly interesting is the rental market dynamics. Manhattan's rental inventory has plummeted 42% year over year, while median rents have stabilized at just 5% below pre-pandemic levels. This stability is attracting investors who were previously focused on southern markets. Bay Area metrics. Silicon Valley's office market is showing signs of life, with Class A office absorption turning positive for the first time in 3 years. San Francisco's condo market has seen a 15% uptick in first-time homebuyer activity, primarily driven by tech workers returning to the city. The East Bay suburbs are experiencing a renaissance, with home prices in areas like Pleasanton and Walnut Creek appreciating 8 to 12% annually. Let's break down these specific challenges and opportunities in each market, as this knowledge is crucial for both investors and home buyers. Florida challenges. Beyond the insurance crisis we discussed earlier, Florida faces several structural issues. The state's property tax system for new residents results in significantly higher assessments compared to long-term owners. New homeowners are paying an average of 62% more in property taxes than their neighbors for comparable properties. Water management issues have become critical. Saltwater intrusion is affecting coastal properties, with 35% of Miami-Dade County's coastal wells showing contamination. This has led to increased utility costs and potential long-term property devaluation in affected areas. Florida opportunities. Despite these challenges, certain market segments show promise. The 55-plus community sector remains strong, with occupancy rates above 95%. Vacation rental properties in the Gulf Coast region, particularly in areas like Naples and Sarasota, continue to generate strong returns, with average cap rates of 7.2%. Texas challenges. Property tax reassessments have hit new residents particularly hard. The average new homeowner in Austin faces a tax bill 45% higher than long-term residents with similar properties. The state's rapid growth has strained infrastructure, with major cities experiencing significant traffic congestion and utility capacity issues. The energy grid remains a significant concern. ERCOT data shows that power demand exceeded capacity 12 times in 2023, leading to rolling blackouts and increased utility costs. New construction in many areas required additional electrical infrastructure investment, adding unexpected costs for developers and homeowners. Texas opportunities. The industrial real estate sector remains strong, particularly along the I-35 corridor. Manufacturing relocations have created opportunities in secondary markets like Waco and Temple, where commercial property values have appreciated 15 to 20% annually. The multifamily sector in Dallas's suburban market shows promise, with occupancy rates above 94% and rent growth of 5 to 7% annually. Northern market opportunities. Chicago's metropolitan area. The city's affordability compared to coastal markets has created unique opportunities. Class B office-to-residential conversions in the Loop are yielding returns of 12 to 15% for investors. The suburban multifamily market is particularly strong, with cap rates averaging 7% and occupancy rates above 95%. Transit-oriented development zones have seen property value increases of 22% since 2022, outperforming the broader market. The city's tech corridor along the Fulton Market District continues to expand, driving demand for both residential and commercial properties. Ohio markets. Columbus has emerged as a major distribution hub, with industrial property values appreciating 28% since 2022. The city's multifamily construction hasn't kept pace with population growth, creating opportunities for investors in both new construction and value-add properties. Cincinnati's urban core revitalization has created opportunities in mixed-use development, with successful projects seeing returns of 18 to 25%. The city's healthcare corridor has driven demand for medical office space, with vacancy rates below 5%. Looking ahead, several key indicators suggest this northern migration trend will continue. Climate impact projections. Insurance actuaries predict Florida property insurance premiums could double again by 2026 due to increasing severe weather events. Climate models suggest coastal flooding events in Florida could triple by 2030, affecting property values in low-lying areas. Infrastructure investment. Northern states are seeing significant federal infrastructure investment, with New York securing $20 billion for transit improvements and Ohio receiving $8 billion for manufacturing corridor development. These investments are expected to drive long-term property value appreciation. The economic forces reshaping our real estate landscape tell a compelling story of regional transformation and opportunity. Let's explore how these changes are playing out across different regions of the country. The New York metropolitan area has undergone a remarkable renaissance that few predicted during the pandemic exodus. Wall Street's resurgence has played a pivotal role, with 2023 bonuses injecting a staggering $35.3 billion into the local economy. An 18% increase that's energizing everything from real estate to local businesses. But it's not just the financial sector driving this revival. The city's tech scene has exploded, creating 42,000 new jobs since 2022, with average salaries reaching $165,000. This influx of high-paying jobs has had a ripple effect throughout the economy. The startup ecosystem has roared back to life, with venture capital investments reaching $12.8 billion in 2023, marking a 25% increase from the previous year. This surge in economic activity has been supported by massive infrastructure investments, with $28 billion committed to transit improvements that are creating 43,000 construction jobs and making the region more attractive to both residents and businesses. The impact on daily life in New York is tangible. Household incomes have grown by 8.2% year over year, while office buildings that stood empty during the pandemic are filling up again, with occupancy rates climbing from 38% to 62% in 2023. The retail landscape has transformed too, with vacancy rates dropping 15% in premium locations, while restaurants and entertainment venues have seen revenues surge by 28% compared to 2022. The Bay Area's recovery tells an equally compelling story of resilience and renewal. The tech sector, once predicted to abandon the region entirely, has stabilized and begun to grow again due to the AI boom. Major employers added 38,000 jobs in 2023, while average tech salaries rose by 12%, reinforcing the region's position as a premier tech hub. The IPO market, long considered a barometer of the region's health, is showing strong signs of life with 15 major listings planned for 2024. Perhaps most significantly, venture capital deployment in the Bay Area surged 32% in the final quarter of 2023, signaling renewed confidence in the region's innovation ecosystem. This revival has been accompanied by a right-sizing of commercial real estate costs, with lease rates now 25% below their peak, creating opportunities for new businesses and expansions that were previously priced out of the market. The Midwest's economic transformation has been particularly remarkable. Chicago's metropolitan area has emerged as a powerful magnet for corporate relocations, bringing 15,000 new jobs in 2023 alone. The city's tech hub expansion has added another 8,500 high-paying positions, while manufacturing modernization efforts have created 12,000 new jobs. The logistics sector has been particularly dynamic, growing by 22% year over year and reinforcing Chicago's position as a crucial national transportation hub. Ohio's economic corridor has undergone an equally impressive transformation. Advanced manufacturing investments have reached $8.2 billion, creating thousands of high-skilled jobs and attracting younger workers back to the region. The state's tech sector has grown by 28% since 2022, while healthcare expansion has added 18,000 new positions. Perhaps most importantly, research and development spending has increased by 45%, laying the groundwork for long-term innovation and growth. Meanwhile, southern markets are facing mounting challenges. Florida's economic pressures have become increasingly evident, with the tourism sector showing concerning signs as per-visitor spending has declined by 12%. The insurance industry exodus has been particularly damaging, eliminating 5,000 jobs and creating ripple effects throughout the economy. The construction sector has contracted by 8% due to soaring insurance costs, while real estate services employment has dropped by 15%. The economic indicators in Texas tell a similar story of growing challenges. The energy sector's volatility has introduced new uncertainties into the job market, while the pace of corporate relocations have slowed dramatically, dropping 45% from its 2022 peak. Infrastructure strain has begun to limit new business growth, and labor markets are tightening in key sectors, creating new challenges for employers and employees alike. Looking ahead, the data suggests this reverse migration trend will not only continue but likely accelerate. Northern tech corridors are projected to add 125,000 jobs by 2025. Creating sustained demand for housing and commercial space. The massive infrastructure investments underway will generate 280,000 construction jobs, while the financial sector's expansion is expected to drive wage growth of 15% across major northern cities. The manufacturing renaissance in the Midwest is particularly noteworthy, with projections showing 85,000 new jobs on the horizon. These economic shifts are creating compelling investment opportunities across northern markets. Multifamily conversions in northern cities are delivering returns of 15 to 18%, while industrial property development in Ohio has been generating impressive 22% returns. Transit-oriented development projects have been particularly successful, averaging 25% appreciation rates. Medical office properties continue to perform exceptionally well, maintaining 95% occupancy rates even in challenging economic conditions. After diving deep into this market transformation, it's clear that we're witnessing an historic shift in American housing preferences. If you found this analysis valuable, hit that subscribe button and notification bell to stay updated on the latest market trends. Drop a comment below sharing your thoughts or experiences. Have you considered making a move? What factors are influencing your decision? Thanks for watching, and watch this one as well.